there were a couple million jobs that disappeared that we were led to believe were created at the time. And, analysts kind of caught on to this, and they gave it less and less credence. Now, the most recent jobs report, we saw that the reported number was 12,000, which is nothing. It's positive. And most of that, not most of it, but a lot of it were government jobs. And when you strip out the government jobs and say, well, what did the private sector do? It was negative. We lost jobs. So, and employment, as people know, tends to be a lagging indicator. So when you see trouble showing up in the employment markets, you may already be in the recession. You just don't know it yet. I mean, the National Bureau of Economic Research, that's they call kind of balls and strikes, and they're the ones who decide when a recession begins and when it ends. It's not a government agency, but they're all, it's like 12 or 14 PhD eggheads who, most of whom have been in government service or all in academia one time or another. But a lot of times by the time they declare a recession, it's already over. Meaning if a recession is 6 months or 9 months, and it takes them 9 months to make up their minds, it's like, well, the recession started, last January or whatever. Like, well, thanks a lot. We've been living through it. We think we knew that. But, and that's okay. I'm not faulting them. I'm just saying that, you can be in a recession, not even know it. You feel it. It might affect you or your neighbors or your business, but there's nobody waving a flag saying, hey, it's a recession. And B, by the time the scorekeepers jump in, it could already be over. So that's one sign. And then within that, just to kind of parse the numbers a little bit, the vast majority of these jobs are going to non-citizens, some legal, some illegal, but none of them U.S. citizens. And they tend to be, not exclusively, they tend to be at the low end of the wage scale. So what's happening is, I'll refer to illegal immigrants in particular, these are the people working for $5 an hour. They're lined up on the expressway entrances, and you pick them up and they'll come, clean your yard or whatever. But if you have enough of those $5 people, the legitimate worker making $8.50 or $9 an hour can't get a raise. Like the $9 guy wants to get up to $12, but if there's a $5 guy waiting in the wings, you don't get that raise. And likewise, the $15 person can't get to 20 because these low income, low wage workers are dragging down the entire wage scale. And that, by the way, is one of the reasons why a lot of big, well-known companies favor all this illegal immigration, because they're the ones hiring, if not $5, maybe $10 an hour people. So A, the labor statistics have been overstated. B, when you adjust them, the economy is a lot weaker than it looks. The jobs that are being created are going to illegal immigrants, and real wages are lagging. So all of this is very bad for consumption. People are just, if they can barely afford to, eggs, bacon, bread, gas and groceries, and, gasoline, the demand for gasoline is inelastic. Like, you need it. It doesn't, you want a lower price, but it doesn't matter how high the price is. You have to pay it because you have to get to work or take your kids to school or drive your pickup truck on business or whatever it may be. Then there are some more technical indicators, but they're there. We had, beginning about a year and a half ago, we had what's called an inverted yield curve. Well, what's that? Well, a yield curve is just a graph. The y-axis is is interest rates. The x-axis are the maturities of certain securities, particularly treasury securities. So 1 month, 3 months, 6 months, 1 year, 2 years, 5 years, 10 years, all the way out to 30 years. And the curve generally goes up from lower left to upper right, which is what you would expect. You say, hey, if I'm going to lend you money overnight, I might want a certain interest rate, but if I'm going to lend you money for 10 years, I want a higher rate because I've got risk, there's inflation risk and sovereign risk and a settlement risk and a lot of other risks, geopolitical risk, etc. So that's normal. But about a year and a half ago, the yield curve was inverted, meaning when you move from left to right, it was going down. Well, what's up with that? Well, first of all, it does happen. It's unusual, but it does happen. And when it happens, it's telling you something. I think, well, why would I take a lower interest rate on a 5-year note than a 4-month bill? And the answer is that I think interest rates are going to come down. I think we're heading into a recession. In other words, that I'll say, 4% yield on a 5-year treasury note might look really sweet in a world of 2% interest rates or 1% interest rates. If you go into a recession, interest rates are going to drop a lot. They're already dropping at the short end. So I will take a lower yield, meaning the inverted yield curve. So when 3-month Treasury bills were around 5.25, you go out to the 10-year note, it was 3.8, and it's higher now. It's about 4.25 today, but at the time it was kind of 3.8. That's the smart money saying, I'll take the lower yield, because when we get further out the curve as time goes by, interest rates are going to collapse and that yield is going to look really good. Now, right now, today, as we speak, the yield curve is upward sloping again. In other words, it's a normal yield curve. It has uninverted. What does that mean? Well, the inversion was a warning saying the recession is coming, but now that it's uninverted, it's saying the recession's here. In other words, intermediate and long-term rates are not going up a lot. They've gone up a little, but short-term rates are plunging. And everyone's saying, oh, the Fed's cutting rates, the Fed's going to stimulate the economy with rate cuts. Nonsense. I mean, the Fed is cutting rates, but that's not stimulus. That's a sign of a very weak economy. When did we have low rates? Well, the Great Depression was one, and we had zero rates from 2009 to 2019, which was a long recovery, but a period of very, very weak growth. Our average annual growth rate for that 10-year period was 2%. Which is way below trend, which is close to 3.5. So, and there are other signs. I don't need to kind of go through all of them, but whether it's technical signs such as an inverted yield curve warning us, and then a now uninverted yield curve, a normal yield curve telling us the danger is already here because rates are dropping at the short end, plus a lot of other signs of liquidity and labor being not as robust as we've been told, and other signs all add up to a very serious warning of recession. Now people go, wait a second, Jim, stock market's had an all-time high. It is. I get it. I look at the ticker like everyone else, but who's to say it's not a bubble? People always say, bubbles. You can't call it a bubble. They're really hard to spot. That's nonsense. There's nothing easier than spotting a bubble. Just look at the Decay index in 1989, the .com NASDAQ 100 composite in 1999, 2000. Said bubbles are easy to spot. What's hard is knowing when they're going to pop. That is difficult, and you don't want to run out and short the market just because it's a bubble, because you can lose a lot of money being right. I mean, that you might be right that it's a bubble and you short the market, but that bubble can expand and the market can go higher. In my view, that's the phase we're in. It's going to break and break hard. Don't know when. And I'm not saying short the market. I am saying just beware. For a long time, go 5 or 6 years, I had I said gold could go to $10,000 an ounce, and recently I revised that upward to, you do the math, you can update it, but kind of $23,000, $25,000 an ounce. I should explain what that is. It's not well, it will get there, but it's not a hard forecast like, buy gold because it's going to $10,000 an ounce. Instead, it's an expression of it answers a question. The question is, what would the dollar price of gold have to be in order to have the dollar backed by gold? In other words, whether you want a hard gold standard or a soft gold standard or any kind of gold reference, why are we not in that system? And what would the price of gold have to be in order to be in that system? And the math is fairly simple. You can do calculus, but this is kind of 7th grade math, or at least where I went to school. So basically, take the money supply, and right away you run into problems. Everyone thinks they know what money is. Well, no, the Fed doesn't know what money is. They have M0, M1, M2, they have all these. Whenever you see 5 different measures of money supply, it tells you right away that the Fed doesn't even know what money is. But anyway, I use M1. M0 is base money. That's the money the Fed prints, but it doesn't mean very much because they print it by buying securities from dealers, and the dealer sends in the 10-year notes or 5-year notes, and the Fed pays for the securities with cash. And that money does come out of thin air. That's not just a metaphor. It does come out of thin air, and they pay the banks. The question is, what do the banks do with it? They give it back to the Fed in the form of excess reserves. So all you're really doing, you're expanding both sides of the balance sheet. You're piling on Treasury securities, and you're piling up liabilities in the form of excess reserves. but that money is sterilized. It's not doing anything. No one's getting to spend it. It's not. There's no velocity. The money that does matter, the money that does drive the economy, doesn't come from the Federal Reserve. It comes from the commercial banks, and that's M1. It includes bank deposits and so forth. So I use M1, and then we know the amount of gold the government has, 8,133 metric tons. People go, it's all in Fort Knox. Actually, it's not. About half of it's, a little less than half is in Fort Knox. The rest is at West Point. There's a vault there. Can't disclose the location, but it's there. And people ask me all the time, say, "Hey Jim, who owns the gold? Is it the Treasury or the Fed?" And I say it's the Army, because they're both Army bases. I mean, West Point and Fort Knox are both. I mean, the legal answer is the Treasury owns it, but it's stored in Army bases. So M2, I don't know the number off the top, or M1, sorry, I don't know the number off the top of my head. You can just go to the Fed website. And 8,133 metric tons, break it down by ounces, divide one by the other, and you, sorry, one more assumption. How much gold backing do you want? Now, the hard shell Austrians will say 100%, if not, it's leverage, or, it's not a solid standard. Historically, that's not true. Great Britain, backed up by the Royal Navy, ran a very successful gold standard in the 19th century. They had about 20% backing. At any given time, the Bank of England had about 20% backing for their notes. The United States used 40% backing until around the end of World War II, and then they went to 25%. And they ended up at zero by the late 1960s. But it was either 40% or 25%. So take your pick. And the British were about 20%. That's what you need to instill confidence. So my math is take M1, take 40% of M1. That's the dollar amount of gold you need to have a strong gold standard. Divide it by the number of ounces in 8,133 metric tons, and you get a number. And that number today is around $23,000. So, but it keeps going up, and the reason it keeps going up is that the gold supply is constant and the money supply keeps going up. So again, fifth grade math, you're going to get a larger and larger number of dollars per ounce in order to back up a higher dollar amount with the same amount of ounces. So it's about $23,000. So just to be clear, that's not saying that gold is going straight to $23,000 an ounce. That's saying if confidence in the dollar were undermined and you had to resort to gold to restore confidence, you can't just pick a number. If the number's too low, it's going to be highly deflationary, which is what happened in the late 1920s. So what would the number be? And the answer is around $23,000 an ounce.